It's Saturday, April 28th, and I want to talk about why mining companies are horrible to own. Don't invest in them. All right. So here's what happened in the account yesterday on Friday. Around sitting around 57,000. Haven't really broken through the 57,500 high that of all-time high that I had. You can see the big movers over here. We got EXK $66, Apple 93, Spotify $51 gain on the upswing again. Other big movers is just wheat and precious metals $95, uranium, energy fuels up $18, and URA, the uranium business ETF, up $20. Not a lot of movement though today, and how fitting that EXK and wheat and precious metals are up today since I'm talking about mining companies. Very fitting. I actually have some notes. Since last time I did notes, it actually kind of turned out into a okay presentation. I'll see if I can duplicate that a little bit and just give you some talking points, I guess. It's like two or three things. You can't really classify them in numbers. It's very hard. But I'll give you some reasons as to why mining stocks are bad to own and why you should not own them. Even though I actually own quite a bit of them, they're extremely risky. It's just a horrible investment. Now, the first reason is because the product they're producing, miners, has an inelastic price, right? So let's say we take a silver producer. The price of silver is determined by the open market. As a producer, as a company, you're basically not allowed to set your own price. Like, you can't just go out in the market and say, well, you know what, it cost me quite a bit to produce the silver, so I have to sell it at a margin. I'll just wait it out if the market's not very hot. So I'll just price my silver at $40 and just wait a year until somebody buys it. Well, that's not how it works, right? People are gonna go out in the open market and just buy it at $15 per ounce. They're not gonna buy your $40 silver. So the price is pretty inelastic, and because of that, project planning becomes really really difficult. So even if you find some resources in the ground, that's reason number two, right? It kind of bleeds into this reason, and even though you might find some ounces in the ground that might be feasible to mine, this project might be obsolete if price goes to $10, right? If the price drops another $5 and you're profitable at 15, all of a sudden this project doesn't look so good and you have to scrap everything and all that thinking power and sampling and perhaps you even purchase that site. It's no longer viable now, so you lose it. You lose all this. So the company could go just bankrupt just on that, just a few dollars price and few dollars drop in price. A company like Coca-Cola, for example, they can pull so many levers to try to adjust their price, right? So they have built such a pipeline for their products that even if their cost goes up, let's say the oil goes up and the plastic cost goes up, they can, try to adjust things in their production to still be profitable. And plastic's probably not going to be that big of a cost in their production to affect them. But even if it was, right, they could just raise their prices, right? They could say, hey, a can of Coke is no longer worth, whatever it's worth, 99 cents. It's now worth $1.19. So they can always adjust the price, even at the wholesale level. So they're not. It doesn't really matter to them what the market price is for things. They can pass that cost on to the consumer, right? They can do that, and a Coca-Cola project is not going to be difficult because of that reason, right? So it's not all of a sudden going to be like, yeah, they have budgets and stuff like that, but that's the only constraint, right? If they say, hey, we're budgeting $1 billion on this project, and that's what they're going to spend, yeah, that's great, and it's always going to be a viable project, because they're going to produce something out of it, and they can cut their costs and stuff like that. But if you're a miner a project becomes totally impossible if the price is not right. Yeah, these guys can always bump up or down the price, so they can play around with that. Another reason why miners are horrible buy, horrible investment is because whatever they're mining, right, the resource actually runs out. Unlike, let's say we're talking about Coca-Cola, the resource doesn't run out. I mean, they can always purchase more from the open market. There's going to be always producers out there, supplying them with water, sugar, whatever they need, oil, plastics, right? So they don't really ever run out of product. Like that's not something that's going to limit the size of their company. Maybe they run out of customers or whatever, or their images goes down. So they have different types of issues, but that's not one issue, right? Not having enough Coke to supply the market. They're gonna, right? They're always gonna have enough sugar and water to get as much beverages out as needed. So that's one thing. But for a resource company, if you run out of sites, if you run out of, let's say, silver in the ground, you're done. The mine is dry. So now you gotta either spend more money into more capex on exploration, capital expenditures on exploration, and you should have done that ahead of time, or you got to buy a new site in order to continue producing silver, right? A new viable site for whatever market price silver is at. Company like Cocoa has different problems, different challenges. Like of course, they need research and development, but it's not like if they stop research and development for like even 5 years, Coca-Cola is going to be just fine. They've had the same product for so long. So a company like that, they don't have to have the gas on the pedal at all times when it comes to research and development and improving their products in order to buy some time and pull some cash for that big expenditure. But a mining company can't afford that freedom, right? They're not very flexible when it comes to um, their expenditures. So that's another reason why it's bad. And the last reason is because of these previously listed reasons. So how many is that? Three, four total. It's that it's very hard to get financing as a mining company, right? So if you're Coca-Cola and you have the stream of money coming in, everybody's going to be lining up to give you financing. I mean, who wouldn't want to give financing for Coca-Cola, right? Everybody would give them a loan. They know they're good for it. Coke's been selling forever. It's going to keep selling. And so, it's only a matter of time until they pay the loan back. But if you're trying to finance a exploration, or a mining company, and let's say they're looking for money for a new project that they've found samples of in the mountain, and they've got like these 5, 10, however many samples they have, and they go to their financier and they say, hey, look, we found these samples, and they have to really convince them. I mean, they gotta say, hey, we got these experts, we got these results, and this is our story. Like, we guarantee we're gonna make money. It's gonna be great for everyone. Price is not gonna of silver is not gonna drop because this and this and that. So they have to be very convincing in order to get financing, and chances are they're gonna get it at a higher interest rate. So they're not gonna be as efficient as a company who gets money at lower interest rate, right? So you can just think about it. If you're buying a car or a mortgage, right? If your interest rate is very high, then it takes a big bite out of your daily ability to save or spend money on other things. It just makes you more inefficient. It makes you get bogged down by debt. You know, higher payments, interest rate payments of any kind, is gonna be hard for your bottom line. So it's very hard to get financing. You know, like a good comparison, I think, when I think of the different companies, like if I think of Coca-Cola, it would be just a stream, like a fire hose full of water, always on and blasting. Or a company like, I don't know, service company. What's a good, I, well, Apple's becoming one, but I don't know. Google. Google's a good example, right? So it's like a fire hose of money always spraying. But exploration, like a mining company, I mean, you're just kind of drinking out of a dark mug, and you don't know how much is left in it, and then you're gonna have to go find another one to drink out of. And it's very choppy and unpredictable, and the stock is volatile, and that's another reason, I guess, maybe five reasons. Is because the stocks are just volatile for all these reasons. It all starts from the inelastic price, but it just cascades down, and because of that volatility, it's less desirable for people, right? For investors to hold that, especially for a long term. I mean, not many funds like to hold mining stocks for all these reasons. So when you're buying a mining stock, just be careful. It's not something you want to maybe perhaps hold for a very long period of time unless they got a really good. The management's figured out a way to have a really nice, pipeline of projects coming in and projects finishing, and just the management is just superb, and it's large enough to be able to do that. But even then, like, you should have this at least some kind of level of skepticism and be really cautious. I mean, if you look at the balance sheets of some of these companies, mining companies, that they're not even in debt. Like, they have millions of dollars sitting on the sideline, and yet they're still trading like they're going out of business, right? When a company like Apple can afford a lot of debt, um, but the stock price doesn't really suffer because of their ability to have a lot more predictable stream of income. All right, so that's five reasons, I guess, that you don't want to buy and invest into mining stocks, and yet I still do it because at some point, they become really really cheap, and even the fundamentals and technicals, when they combine to create just like this extremely undervalued asset, then it's very tempting. It's very hard not to buy. And so that's kind of why I've been going in EXK lately. Well, let's go look at the EXK right now, actually. Um, it's my favorite company to trade. I always make money on this company, so it's really nice. It's sitting at 225 right now. If you remember last time, I bought 200 shares at 210, and I just now started to scale. I found it undervalued starting at 210, but it quickly popped up. So now, now I'm just sitting on it. I have 600 shares total, and because of that quick pop, I'm just idling. If it goes down to like $2, I'll buy some more. If it goes up to three, I'll sell those 200 shares and maybe even look to sell the rest of them. My valuation, of course, of the silver company is based on the price of silver, and you should do your own valuation or listen to an analyst. I'm not an analyst, just a retail investor, just like you. So be careful and don't take my word for everything. But there's no reason why we can't be learning from each other, and so I'm trying to take this account 1 million. I don't know why you're not. And if you are, good, let me know how you're doing. And that's about it. Watch out for those mining companies, you know what I mean? All right, peace out.